Brad Williams, caps, floors, and collars. In this section, we introduce caps, floors, and collars, all of which are a combination of calls and puts on SOFR that can be used to control interest rate risk. We begin the analysis by considering a single future period for a loan and how the cost of the loan over that period can be constrained with a single call on SOFR or a single put on SOFR. As we will see, these applications involve the same logic as forward put-call parity. A caplet. Assume that a firm needs to borrow $10 million for a 3-month period beginning 4 months from now. Assume also today the 3-month forward SOFR for a period starting 4 months from now is 8%. In terms of our notation, FRA 47 equals 0.08. Given this financing need, there are at least 2 ways that the firm could arrange now to borrow these funds at a fixed rate of 8%. One, with FRA 47 equals 8%, the firm could enter into a loan agreement at a fixed rate of 8% for the period in question. 2, with FRA 47 equals 8%, the firm could enter a floating rate loan by purchasing a call and selling a put for the same period, both with a strike rate of 8%. From our discussion of forward put-call parity, the price of the call and put would be equal, so the long call short put combination would be costless and the borrowing costs would be fixed at 8%. Instead of purchasing either of these alternatives, the firm might merely wait to see what price prevails for 3-month SOFRs in 4 months. If the firm does this, it might result in paying a higher or lower rate than the 8% that the firm might reasonably expect to pay for its loan based on the prevailing forward rate. Whatever rate prevails, the actual interest cost of the loan will be observed SOFR times 1 divided by 4 times 10 million, where in our example, the observed SOFR is the 3-month rate prevailing at month 4, and the interest payments will be due at month 7. Rather than bearing the full interest rate risk associated with its financing need, the firm decides that it would like to limit the maximum interest rate it has to pay to 8.5%. Given the prevailing forward rate of 8%, it should be possible to transact to guarantee that the actual rate will not exceed the desired 8.5%. To place an upper bound on the actual cost of the loan at 8.5%, the firm purchased a call on 3-month SOFR with a notional principal of $10 million to expire in 4 months, which is the same time that the loan commences. The payoffs on this call will occur at month 7 and will be max observed SOFR minus 0.85 times a quarter times 10 million. We now evaluate the total financial results on the loan and the call on SOFR. Assume that the observed SOFR at month 4 for a 3-month maturity is 9%. The interest cost of the loan will be 0.09 times a quarter times 10 million equals 225. And the payoff on the call will be 0.09 minus 0.085 times a quarter times 10,000 equals 12.5. Thinking of the loan cost of $225,000 diminished by the 12.5 payoff on the call, the outcome is the same as if the firm entered a loan at 8.5%, for which the interest would have been $212,500. From this, we can see that the firm has put an upper bound on the cost of the loan at 8.5%. Through the purchase of the option. In market parlance, we could say that the firm has capped the loan at 8.5% through the purchase of the call on SOFR. A caplet is a call on SOFR purchased in conjunction with the floating rate loan to cover a single period. An interest rate cap is a sequence of calls on SOFR organized to correspond to multi-period floating rate loan based on SOFR. Note that the 8.5% rate on the loan does not include the cost of the call in the caplet or the sequence of calls in the caplet. To review our example, consider the following facts. The firm initiated a floating rate loan for a 3-month period to begin in 4 months. At the time the firm initiated the loan, the relevant FRA rate was 8%. FRA 47 equals 8%. In conjunction with the loan, the firm purchased a call on 3-month SOFR to cover the same period with a strike rate of 8.5%. As we have seen, combining the floating rate loan with the purchase of the call effectively capped the loan rate at the strike rate of the call, or 8.75% plus the purchase price of the call. This capped loan also allows the possibility for the loan cost to fall below the anticipated cost of 8%. If the observed 3-month SOFR at month 4 is 7%, for example, the loan cost would be the 7% market rate plus the cost of the call. To evaluate the cost of the call, let us assume that the yield curve is flat at 8% and that the annualized standard deviation of the 3-month SOFR is 0.25. According to equation 1912, with this data, the call will cost $6,342.45. Brad Williams, Frugal Finance. See you soon.